Chris Lowe is always part of the story. Let's bring him in right now with FTN Financial on housing. Let's get right to year over year, how much more of a house price decline?
Oh, wow. At least 5%, and I would think more likely it's going to be in the neighborhood of 10%, Tom.
Is that psychologically, A, in the market, and B, in the American psyche?
Well, it depends partly which market you look at. If you look at financials, for example, they have been particularly weak in the S&P, and that's because a lot of the earnings from financials in the last year has come from writing down the loan loss reserves for housing. And the fear is we may have to write those back up again.
Do you hedge that?
Do you hedge it?
Do you hedge a negative 7.5% price decline?
I think you're probably supposed to. But what's interesting, when I go out and talk to people, even when I show them the house price numbers, which have begun to fall already,
right,
they just don't want to hear about it.
That's
Not
what I'm
another 10% decline.
Exactly. I totally agree on that. I don't think it's in the psyche of the country. Dreaded first charts on the psyche of surveillance. Midday, let's look at it. Low considers lower growth. You must have been in fourth grade and they were making jokes about that, right?
Yeah.
Like, you're very keen. Peachy Keene.
Peachy Keene and lower growth, and yeah.
We could never have been a folk group, low Keene. It just doesn't work out. There it is, real GDP. What's the FTN Financial call? Do you bring in that revision, and where are you for second and third quarter?
I am still actually quite optimistic, and here's what's going on. In the second quarter, we do have weaker consumption, and so it's going to look like we're really losing steam. I've got consumer spending up 1.5%, which is very, very weak, and that's because of high gas prices. But I think those gas prices will start to come back down by the third quarter. In the meantime, we have a couple of special factors: defense spending, construction spending, that ought to be stronger in the second quarter, keep things going.
In defense of the cynics, they've been talking about special factors for 4 years. Can we sustain 200,000 a month job growth with even like 2.8, 3.2%?
I think it really is as simple as if gas prices come down to, say, $3.50 by September, we're fine. And in that case, yes, you can.
Okay.
But if they don't, we're in trouble. And I have to tell you, looking at jobless claims, you know, that in April we gave up all of the declines in the first quarter. That has me a little nervous. That's been a terrific leading indicator for 2 years.
I just noticed on the side of the TV screen, if I lean my face in just enough on camera 4, I look like one of William Kentridge's paintings with that big nose. Let's bring that in. Look at that. It's like one of William Kentridge's famous paintings from the 70s. That's sick. Okay, chart 2. That was really ugly. Here, let's look at this one right here. In search of comfort and confidence, a Bloomberg Consumer Comfort Index, the old ABC index, we took it. I'm thrilled we have it. Weekly data. Look at where we are. Is the national mood as gloomy as what I see there in the Bloomberg Consumer Comfort Index?
I think it is, and it's actually having an impact on the economy. So, you know, the Bloomberg Consumer Comfort Index says we are still in a recession as far as people are concerned. Same thing in a Gallup survey where they actually asked people, are we in a recession? More than half said yes.
What keeps you up at night within your relative optimism here? What keeps you up at night?
Well, it's the number of really crazy special factors around the world. So you've got the situation in Greece. You have oil prices and the situation in Libya. We still have issues in the banks that have yet to be resolved. And you have the Fed, I think, doing everything they can to keep the economy going.
Right.
But I'm not sure how effective QE is in terms of economic stimulus.
You nailed this. Here's the research note. Chris Lowe, bringing up here, FTN Financial, nearly 40% of spending is in excess of receipts. And not just this year, you go back 2 years. That's remarkable. Just absolutely remarkable, isn't it? We're going to have a chart in the next section on this. The deficit is more deficit-y than most of us think, isn't it?
It is. And unfortunately, if we cut it aggressively, quickly, that's going to have an economic impact. So best thing that could happen is if one of these commissions, maybe the Biden commission, works out a deal where everybody's committed to making the deficit shrink over 10 years. The markets would like that if it has teeth, some kind of enforcement action. But I think at the same time, it has to include spending cuts. It has to include tax increases. The pain has to be spread enough that it doesn't hit one group so hard that you get a situation like Greece and Spain where people are in the streets.
Brent, where does Brent at 109, where does it need to go to give you that consumer good feeling?
109 is already backpedaling enough that we ought to see some gasoline price relief. The spread between a cracked barrel of crude and an uncracked barrel is very, very wide right now. I suspect when the Mississippi starts to recede, and those refineries at the mouth of the Mississippi are okay, at that point we get some price relief.
Fred Goodwin joins us now, Nomura International in London, and Chris Lowe here in New York. Fred, no one can be surprised about what we saw over the weekend in Europe. Why the market reaction if no one's surprised?
It seems that's the way it evolves. So this weekend, certainly the pain in Spain was a bit more extreme than perhaps even the pessimists' forecast, because now the socialists have had their worst election result in their history and only control 3 out of the 17 states. And so it's going to cause bond investors to be very, very much concerned about whether the bond vigilantes are going to stay outside the Spanish border or right on in.
Right. Chris Lowe, why should Americans care about Spain? Why should they care about the Fred Goodwin world?
Well, look, the ball is rolling here, and bond investors are waking up to things like debt to GDP ratios. And we happen to have a fairly high one here, and it's rising fast because we have a deficit to GDP ratio of about 10%.
Okay, best chart of the weekend, Christopher Lowe, Fred Goodwin, I want you to comment on this. The deficit 60 years on honored Taupin and Elton John. What a great song off Tumbleweed Connection. And you look here, Fred Goodwin, at the cash deficit. Forget about ratios. There it is, folks. This is a long-term view, and you can see it back to 1950 where there was no deficit. And then it was terrible under Reagan, and there's that Clinton surplus, and over we go, and off a cliff of actual cash deficits. Fred Goodwin, what is the view from Europe of Chris Lowe's cash deficit in the United States?
Well, I think the U.S. gets a lot of attention over here because they are effectively getting a free pass thanks to the fact that they are the reserve currency of the world. But, we look at the U.S. deficit from London at alarm. And, of course, we don't really think that the politicians are quite ready to get serious about it. It's okay to have a plan, but there doesn't really, we're not very optimistic about much happening before the 2012 election.
Right, Fred, let's bring it back to Greece. And Chris, you can comment here. Here's headlines, folks, off the Bloomberg. Victor, come on over here and take a look at this. And this is the spokesperson for Papandreou. Greece aims for a 2011 deficit of 7.5% of GDP. They want to be below 3% in 2014. Fred Goodwin, are they just out of promises? I mean, is that all there is to it? You can only promise so much. Do you need to see action out of Greece, or does the rhetoric still work?
Well, I think absolutely they have to have action. And the one thing that has been an issue is the pace of privatization. But Europe has this way of operating right now, which is to extract commitments from Greece or Portugal or Ireland in return for aid. But it's definitely the carrot and stick approach. And so Greece, in order to get additional aid, is going to have to perform on privatization, which I think they're going to do. Now, the offset to that, or the worry point, is things like what happened in Spain. Can the politicians stay in power? And if they aren't able to stay in power, will the new politicians continue to deliver on austerity?
That's nicely put. Right. Chris Lowe, I mean, you've got repositioning. Can we get a banner up? Goodwin invents word called privatization. I have no idea what that means. Repositioning, privatization, it's all rhetoric. Are we near that rhetoric in the United States?
Well, yeah, to some extent we are. I think one of the big things here we need to keep an eye on, too. We are the world's reserve currency right now, but that is already changing. And for example, the big commitment by China to invest in gold is a move away from the dollar. It's not overnight, but we probably have between 5 and 10 years to fix this problem, after which, if we haven't got the debt to GDP ratio down, or at least the deficit to GDP ratio down to 2-3%, I think we're in real trouble.
Yeah, earlier this morning, folks, on Bloomberg Surveillance, I spoke with Robert Sinch of RBS, and I outlined the importance of examining a country's top-line nominal GDP.
Nominal GDP really is sort of like a top-line revenue number for a company. It's how much revenue is being created within that economy. And for some of the periphery economies now that have nominal GDP growth that's dangerously close to zero, they have even two-year borrowing costs that are running hundreds, if not 1,000 basis points above their nominal growth. That's just an unsustainable situation, particularly if you have a large amount of debt to service, and they do.
I want you to both comment on this. Robert Sinch, RBS. Fred Goodwin, do you look at nominal GDP in these peripherals, and does it make you cringe? And can public policy jumpstart nominal GDP?
Well, I think you have to look at nominal GDP because it's the debt sustainability calculus is a function of nominal GDP against your financing costs or what the average rate of borrowing costs are. So you have to get that mix right in order to turn the unsustainable debt to GDP picture into something far more sustainable. So it's critically important.
I mean, you look at this, Chris. Let's bring it over to the United States. Subpar nominal GDP here. How much animal spirits do we need in the U.S. to really sustain 200,000 jobs? Do we need over 4%?
Well, look, I think we're just about there in a sense, because we've now had 3 months with private payrolls up more than 200,000 for the first time since the recession. And my sense is that is the 4% growth that we had coming into this year. Now, of course, it's weakening a little bit, but yeah, I think we need to keep things going at 4% or so real. And what's tough, you look at the numbers in the first quarter, retail sales, for example, looks really good until you realize how much of that is gas inflation. You back out those gas prices and you've got sort of 0.1.2 a month.
It's just not good enough, is it?
It's not enough, no.
Can public policy jumpstart economic growth?
I don't think at this point it can. I think we are in a place, though, again, if we get some commodity price relief, particularly gasoline, we'll be okay. We're already there.
Fred Goodwin with us from Nomura International in London. Fred, you look at all this. We got to go back to basics. Bring up elegant chart here, number 3, Rex. And there it is, Greece, Germany, and Spain, Germany. And there's a great divide, Fred Goodwin, between Spain and Greece. What are the common features of the solvency issue of Greece and a less serious issue in Spain? What are the common features of the two peripheral nations?
Well, it's pretty simple, really. I mean, the fiscal sustainability calculus in Greece is much worse. So they have a debt to GDP, I believe, is something like 160% of GDP. So the austerity measures that they needed to take in order to achieve sustainability were more severe. Plus, it's also a function of the market price. As their yields get higher and higher and higher, it becomes more difficult for them to fund themselves. And this has largely not happened in Spain. There's been the attempt to stress test the banks. There have been some reforms on pensions. They extended the age. The retirement age, which, over the course of the next 30 years should lower the debt to GDP by as much as 30 basis points. So there's been some good news, and the market has basically taken the view that Spain is not going to go the way of Greece, Ireland, and Portugal.
Fred, you're in the job of actually putting capital at risk. So many people are stepping aside here. I think of Mark Chandler at Brown Brothers Harriman. Are you in an active mode here? Did you come in on a Monday in London and say, oh, this is fun, let's put capital to work? Or are you under the desk hiding?
Yeah, I'm of the view, and have been for a while, that this is a very interesting year because what the market is learning over and over again, if you go back to first the oil spike in the Middle East on the back of regime change across in many places, or the Japan earthquake, or more recently, the Japan slowdown, the U.S. slowdown, the market has learned over and over again that it is a lot more resilient and the economy is a lot more resilient. So I look at these type of episodes as a buying opportunity for risk. Whether that is in going along the equity market or buying a commodity currency or indeed buying Spain against Germany.
Right.
I would look at all of these as opportunities.
Fred Goodwin, I was watching Red Sox Cubs last night out of Fenway Park, and this chart came in my brain. It was like, this was so exciting. Look at this regression, folks. Euro crisis is Hildenbrand's headache. Fred Goodwin, I took Euro Swissy, I took it back to 1980. And I regressed it out, and we're 4 standard deviations plus strong Swiss franc. Everybody just assumes Switzerland will continue with this strong Swiss franc and take their lumps. That can't be true. When does Switzerland start screaming?
Well, the currency is relatively small, and it's obviously enjoying safe haven premium as people exit euros for the safety of Switzerland. And I don't know when it's going to end.
Right.
I don't know if the authorities have the power to end that. So good question, but I don't have an answer for you.
Fred Goodwin, thank you so much. Nomura International, we leave him where he doesn't have an answer. We'll have to have him back.